plans and avoid knee-jerk reactions based on temporary market movements. Discipline, on the other hand, is what holds a trader to their trading plan, ensuring they stick to pre-established entry and exit points, risk levels, and keeping emotions like fear and greed at bay. A disciplined trader recognizes that not every trade will be a winner and is mentally prepared to handle losses. They also know when to walk away to avoid pouring good money after bad. Finally, a solid understanding of the markets is non-negotiable. This involves studying and understanding market indicators, economic factors, and even geopolitical events that could impact asset prices. Without this knowledge, traders are essentially navigating blind, reliant on luck rather than informed decision-making. The truth is that futures trading is a serious and challenging endeavor. It is not a shortcut to immense wealth or an easy side job for additional income. It requires a significant commitment of time and effort, a well-thought-out strategy, and the mental fortitude to stay the course even in the times of market turbulence. For those seasoned traders out there, what was the most valuable lesson you learned in your early days of trading? How did you foster the patience, discipline, and market understanding necessary for successful trading? Sharing your experiences could provide new traders with a much-needed reality check and better equip them for the path ahead. The pitfalls of overtrading, how the pursuit of quick riches can lead to deep losses. The desire to get rich quickly is a siren call that many new futures traders find hard to resist. This alluring promise can lead to harmful trading behaviors like overtrading and taking unnecessary risks, all in hopes of striking it rich. However, this approach often backfires, leading instead to significant financial losses and emotional distress. Overtrading, or the act of making excessive trades without a sound strategy, is a common symptom of the get-rich-quick mentality. The thought process is simple. The more trades you make, the higher your chance of hitting the big, profitable trade. However, this couldn't be further from the truth. Each trade carries a risk, and the more trades equate to more exposure to risk. Overtrading can quickly erode trading capital, especially when transaction costs are factored in. This mentality can push traders to take unnecessary and disproportionate risks. Driven by the desire for quick and significant returns, they may place trades with money they can't afford to lose, or enter highly volatile markets without fully understanding the potential downsides. Such reckless trading can result in devastating losses, often wiping out a trader's account and even plunging them into debt. Remember, futures trading is not a lottery or a gamble. It is a strategic endeavor that requires careful planning, risk management, and market understanding. Quick riches should never be the goal. Instead, focus on developing a robust trading strategy, managing risks effectively, and continuously learning about the futures market. Remember, the goal of trading is not to win big on every trade, but to build steady, sustainable profits over time. Experienced traders, what advice would you give to newcomers drawn to the markets by the allure of quick profits? How did you manage to resist the temptation of overtrading or to take unnecessary risks? Sharing your insights and experience with these could help new traders avoid these common pitfalls and set a course for sustainable, long-term success in the futures market. Risk perception. Discuss the psychological biases where traders underestimate the risks involved in the pursuit of potential profits. Underestimating risks in the pursuit of profits, a dangerous psychological bias in futures trading. In the world of futures trading, a clear understanding of risks versus reward is vital for making sound trading decisions. However, many traders, particularly those new to the markets, fall prey to a dangerous psychological bias, the tendency to underestimate the risks involved in the pursuit of potential profits. This bias, often referred to as optimism bias, is not limited to trading. It is a universal human tendency to overestimate the chances of positive outcomes while disregarding or downplaying potential negatives. In the context of futures trading, this could mean focusing on the potential profits of a trade while overlooking or underestimating the probability and potential extent of a loss. When optimism bias takes hold, traders might ignore warning signs such as sudden market shifts or risk factors related to the underlying assets, assuming that these potential issues won't impact their trades, or they might hold onto a losing position for too long, convinced that the market will turn in their favor only to suffer substantial losses. This bias is particularly dangerous because it can lead traders to take on excessive risks, believing their trades are safer than they actually are. It is a path that can lead to financial losses, emotional stress, and in severe cases, trading accounts being wiped out. The first step in combating optimism bias is recognizing it. Traders must consciously acknowledge the risk in every trade, regardless of how confident they feel about the potential returns. This involves setting realistic profit targets, establishing firm stop loss levels, and never risking more than a small percentage of trading capital on any single trade. Psychological biases are significant obstacles in trading, but with awareness, they can be managed. Experienced traders, how have you dealt with optimism bias in your trading career? What steps did you take to ensure a balanced perspective of risks and rewards in your trading decisions? Sharing your experiences could help newer traders develop strategies to manage their biases, leading to more informed and safer trading practices. How have you dealt with optimism bias in your trading career? What steps did you take to ensure a balanced perspective of risks and rewards in your trading decisions? Sharing your experiences could help newer traders develop strategies to manage their biases, leading to more informed and safer trading practices. Explain how this leads to a lack of proper risk management, such as not setting stop losses, risking too much capital on a single trade, or ignoring market signals that goes against their trade. The dangerous downfall. How optimism bias leads to lack of proper risk management in futures trading. In the high-stakes arena of futures trading, risk management is a trader's best friend. However, the optimism bias, a psychological tendency to underestimate risks while overestimating rewards, can blindside traders, leading to significant lack of proper risk management. Setting stop-loss orders, diversifying risk across multiple trades, and listening to market signals are all critical aspects of risk management. However, optimism bias can make traders ignore these protective measures, convinced that their trades are invincible and will yield profits. This leads to a host of risky behaviors that can quickly turn potentially profitable futures trades into financial disasters. For example, an optimistic trader might forego setting stop-loss orders, assuming the trade will go their way. Stop-loss orders are designed to limit a trader's loss on a position in a security and are a crucial tool for risk management. By not setting these, traders expose themselves to unlimited losses if the market moves against their positions. Similarly, in their pursuit of significant profits, traders under the influence of optimism bias might risk too much capital on a single trade. This all eggs in one basket approach magnifies the potential damage